Hello, everybody. Ed Yardeni here. It's Monday, July 6th, 2026, and it's 11 a.m. In Eastern Standard Time here in Long Island. Here in Long Island, we had all sorts of forecasts yesterday of torrential rains and flash flooding and thunderstorms and all that. It is raining, but we haven't gotten all the terrible consequences. If we happen to do it, if that happens while we're in our conversation, there is always a possibility that the cable will go down, the internet will go down, in which case if you just hang around for a few minutes, I'll try to get back on, but hopefully we won't have any disturbances. One of these days, Skylink will connect us all, I suppose, and we won't have to worry about cable. What is there to worry about? Well, some of you may have heard me shout out Max's name. I was worried that he wouldn't hang around, and I was right. He was sitting right behind me. I gave him two treats. I treat the guy right, and this is what he does. He walks away. I guess he's just kind of been there, done it with these calls, these calls that we have, and I hope that's not the case for you folks. Speaking of being there and doing it, we're all in the same business. We're all watching the same news, the same economic indicators, the same geopolitics, what's happening in the Middle East, what's happening both geopolitically and in domestic politics. So are all the investors that make up the stock market, and they've been remarkably laid back. It's not clear that the Strait of Hormuz is actually wide open. It's really, from what I understand, it's not wide open. Chinese vessels are getting through. Some Indian vessels are getting through, but it's not back to its normal run, and yet the price of oil has taken a huge dive. A benefit of hindsight, we have to recall that there was a bear market in oil from about 2022, early 22, when it peaked on Russia invading Ukraine. It came down fairly significantly through the beginning of this year, and then the war hit and the price spiked up. But as soon as we got, I don't know what it is, it's a ceasefire, it's a pause, whatever it is, the price of oil came tumbling down. And I think it's partly because the bear market before the war occurred because the Chinese have really adopted electric vehicles pretty enthusiastically. In addition, I think China's economy is not doing all that well. It's kind of slowing based on the fact that they're, I think, in the fifth year of a pretty nasty property recession, depression, and nothing's really been done to alleviate that pressure. And the Chinese tend to be big savers, and they were putting a lot of their money in real estate, and so they've really gotten hard hit in a very illiquid asset right now. In the stock market, they've been getting whipsawed around. Stocks in China have been a pretty good trading vehicle for the past few decades, but other than that, has not been a good place to invest. And so they haven't done very well there. I guess over the past couple of years, they got into gold. Gold was going up, so that certainly was a promising way to try to make some money with your investments. And that worked until it didn't work, got up to 5,500 before the war. And then who would have thunk that the war happened? And usually you would have thought, I would have thought that that would lead to higher gold prices. But it turned out that some central banks and emerging economies whose currencies were taking dives because the war was shutting off their oil, because of that, the countries like Turkey had to sell gold, certainly stop buying gold, but also sell gold. So it's all kind of traded very technically. It came down from 5,500 down to its 200-day moving average, and then it got down to 4,000. And I showed you a chart that show that there's a upward leaning, a rising channel in the gold market, and 4,000 seems to be kind of the next support area, and looks like it's holding. There's some challenges to it, of course. The Fed has pivoted to a more hawkish stance. As a result of that, the potential for higher interest rates certainly doesn't help gold, and the potential for higher interest rates helps the dollar, but it doesn't help gold because of the stronger dollar. Um, Yet I'm thinking that it's going to hold the 4,000 level and may continue to recover here. So in the commodity space, we got oil prices down a lot, gold kind of struggling, copper's over $6. It's kind of a amazing rally that nobody's paid much attention to, but obviously has a lot to do with the AI trade and the need for copper in the electronics area. And meanwhile, the stock market just keeps going higher. Uh, there is in the quick takes that we wrote over the weekend, the one that's called U.S. Market Call. The title was a bubble in bubbles in question mark. There's a lot of bubble talk out there. Lots of the perma bears have come out recently growling that this is the biggest bubble of all times, and it's going to burst, and it's the AI bubble and whatever else they see bubbling up. Um, I mean, usually you don't get that much concern about bubbles when you have a melt up situation kind of comparable to what we had in 1999. But so from a contrarian perspective, I'm glad to see that people are worrying about bubbles. I'm not ignoring them. I'm not saying that there aren't bubbles out there, but we already had a couple of years ago we had a bubble in SPACs and meme stocks, and those bubble burst and nothing terrible happened. Arguably, this is a much bigger bubble if that's what you think it is, because of all this money being spent on AI. But look, we use at Yardenia Research, we use AI all the time. It used to be Google search. Now we use Claude and Gemini, and it's kind of a research assistant. It's a very useful tool. And then Melissa Tagg is, who I now call Claudette because she uses Claude so much. She's really good at prompting Claude. She didn't have any experience in coding before, but she's become an outstanding prompter. And she's creating a lot of AI tools that are posted on the website for monitoring some of the Fed releases that come out, and she's working on some others that will present to you when they're available. So it's back to our story of FOMO versus FEMO. FOMO is fear of missing out. That tends to be a valuation multiple expansion that can create irrational exuberance. Um, as Greenspan asked it in 1996, December 5th, 1996, how do we know if there's irrational exuberance in the markets? He asked the question. He didn't have the answer at that time. But we always know with the benefit of hindsight that, oh, yes, that was a bubble. Oh, yes, it was irrational exuberance. But for now, I see a lot more FEMO than FOMO. FEMO being our coinage for the idea of fabulous earnings momentum. And maybe that's where the irrational exuberance is. Maybe analysts are being too exuberant, but the analysts are getting exuberant by what companies are reporting. The first quarter earnings numbers were absolutely awesome. And then the second, third, and fourth quarters of this year are expected to be up more than 20% per quarter on a year-over-year basis. So that's pretty remarkable. And as I'll show you in a few minutes, when you take all the analyst expectations for their S&P 500 companies in 2027, they're up to $402 a share for operating earnings for the S&P 500. 402. I think currently they're up like 375, but 402 is a remarkable number. And again, it's double-digit earnings growth. Uh, and if that's what the market discounts at the end of this year, 402, let's round it off to 400, make the arithmetic easy. 400 times, let's say, a multiple of 20, which is kind of where we are right now. And there's no reason why it needs to go down unless we get another recession scare or an actual recession. But if at the end of the year, the market investors are fairly confident that the economy is still growing and give the market and assign that $400 20 multiple, we'll get it the S&P 500 up to 8,000 by the end of the year. Well, why are we talking 8,250? Well, because the analysts keep raising their number for 2027. By the end of the year, that'll be forward earnings. By the end of the year, 2027 is what the market will be discounting. And so we're using 8,250. Let's first turn to the morning briefing and have a look at the story there, which is really all about the employment report. And Elias did a lot of the research on that, did a good job, I thought. And then we put it together. Um, and well, we do at the Ardeni Research tend to be optimists at heart, so we're putting a relatively positive spin on the data. It doesn't look all that positive. We had this big increase here, and then the month over month was 57,000. When you look at the 3 month, which is right here. This is a 3 month for all employment, payroll employment was 111,000. Now, before this number came out, the 3 months was 188,000. So I guess we kind of got spoiled. Remember, it was only a few months ago where everybody said that the break-even payroll employment number is 50,000. So we're double that. But on the other hand, the expectations were higher, and so that was viewed as a downer. Well, it turns out that part of that, what might have been a statistical issue with leisure and hospitality. Leisure and hospitality, as you can see, was down sharply. We're used to that being a pretty solid number on a month-over-month basis. That's one of the areas where payroll employment's actually grown in the past. But that's not happening. That didn't happen in June. And one of the explanations for the statistical anomaly is Memorial Day came earlier in May, and so the hiring might have started sooner. There's also the whole question of FIFA and whether that led to a lot hiring of a lot more leisure and hospitality, or whether they were fully staffed and ready for FIFA no matter what. But this looks like it's a candidate for being reversed. Some of the other areas of strength have been healthcare and social assistance again, and people keep taking that as if it wasn't for that, employment will be much weaker. Well, it is what it is. It's in there, and it obviously is getting a big boost from baby boomers as they get older. They need more healthcare services. Professional and business services was a solid gainer, and maybe that's an indication that AI isn't destroying jobs, and that more and more people are keeping jobs or getting jobs, particularly if they got any skills at working with AI. But look, the economy is growing, it's expanding, and so having that category increase, which is typically what it does during good times. Private educational services. Construction was up modestly, but that may be because there's a shortage of labor in that sector. There's no shortage of jobs. Maybe there is in single family housing, maybe even multifamily, but certainly not in non-residential construction. So here we have healthcare and social assistance, all-time record high. We have professional and business services. It's kind of stalled out at a record high and started to increase a little bit. I think part of the problem is we hired too many people during the pandemic when there was a perceived shortage of labor at the time. and we may just kind of got to absorb all those people without increasing the payrolls. Same thing. Here's the professional and business services, the two components. So this is interesting. Administrative and support services. Those are the people that are supposed to get replaced by AI. Well, maybe that's not the case. What else can we talk about here? Oh, that's job openings in professional and business services. Look, these are volatile series, so the next move might be down, but that's mildly encouraging. Payroll, employment, and construction, all-time record high. Again, maybe kind of leveling out, but I don't think it's because the construction companies hired too many workers back in the pandemic, which they didn't. I think it's that there's just a supply issue in terms of people with the skills. There's a baby boomer issue. Baby boomers are retiring. There's a skills mismatch issue as well, and of course there's a foreign workers issue with the tighter immigration laws and enforcement, I should say. Let's see. Yeah, this is residential is weak for construction. Non-residential continues to move higher. Um, Manufacturing, we're starting to see maybe that's kind of bottomed out. Maybe not, but there's some signs of improvement there. Certainly in the payroll diffusion index, this is manufacturing, and you can see this kind of looks like the purchasing managers index, and it looks like it's firmed up rather nicely. We've got the leisure and hospitality. Again, they hired a lot of people. Maybe, uh, but there has been a slight upward trend in that area. Um, let's skip that. Retail sales, as we said, if the economy is weakening, you're not seeing it in the weekly retail sales numbers. And what's going on here? Remember, this is retail. This is same store sales index from Redbook. Uh, Correlates reasonably well with retail sales, excluding food services, autos, and gasoline. Um, I don't. I mean, this could be inflation, but I think it's actually the overseas guests that have come to watch soccer live in the United States, doing some retail shopping, going, well, this does not include restaurants, but if they're going retail shopping, they get hungry and they go to the restaurants. This is the diffusion index for all industries, also looking pretty good. It's not just, it includes manufacturing. The unemployment rate, yeah, it dipped down to 4.2%. And yes, it was for not great reasons. The labor force dropped by more than employment dropped. And as you know, there's two measures, surveys of the labor market. One is the household survey, which is what this is based on, and then there's the payroll survey. Uh, but it is what it is. The unemployment rate is 4.2%. And that does reflect more of what's happening on the supply side than the demand side. There are fewer people looking for work. And so the civilian force participation rate took a drop here. And I think this has to do with baby boomers. Many of them are no longer in their 60s and working. They're in their 70s and retired and traveling. They're in their 80s, maybe, staying closer to home. But the participation rate is partly because of retiring baby boomers. But it looks like younger people are also dropping out, and where everybody's kind of puzzled by that. Could be AI, but sort of doubt it. Um, Let's move on here. Civilian labor force, this is the supply side of the labor market. Year-over-year percent change, you can see it's actually falling. The 12-month doesn't reflect it yet, but it will shortly. But for the here and now, the year-over-year, you're seeing a slight decrease in the labor force. Um, I want to move ahead here a little bit just so we can catch up on the other. Yeah, this is just the same story we've been telling about the baby boomers retiring, and you can see that and so in terms of Social Security benefits in 2025, 1.85 million people collected Social Security. You can see that the pace has been increasing, and that's just confirms what we know about baby boomers retiring. And as we've discussed before, once they retire, they aren't getting W-2 income. They're living on their net worth and maybe dividend income, interest income, whatever. But here's the participation rate of the 65 years and older. This is the men has dropped sharply. Women not so much. Um, let's move on a little bit further here. This is the civilian labor force participation rate for 25 to 34-year-olds. That honestly looks like an aberration to me. It was a very strange report, I have to tell you. I, I I think most observers agreed with there were a lot of weird things in the report that just didn't really kind of make sense or add up. It doesn't make sense that the foreign-born uh, population and labor force is declining. Let's keep going. Oh, here's that Jerome Powell chart where he came up with a way to look at supply versus demand in the labor market. So supply is just the labor force. The demand is household employment plus job openings, and it's in balance. So from the mandate perspective of the Fed's mandate, labor market's okay. No particular reason to worry about it, especially with an unemployment rate of 4.2, 4.3%. And so the concern rightly should be on the inflation side of the mandate, which is where it is right now. We are, especially now that we're seeing that the demand for labor minus the supply of labor has turned back up a little bit. So the demand is just slightly ahead of supply. And look, I mean, let's not get too carried away here. These are statistics that can be revised, but in terms of the big picture, there was a huge demand for labor over here, and a lot of hiring that went on, and maybe that this is sort of the tail end effect we're causing. Well, the on the wage side, wages were up 3.5%, which doesn't shouldn't be concerning on the inflation front. It could be concerning on the purchasing power front, but Elias pointed out that the inflation number for June may very well be something like close to minus 0.1% because of the drop in gasoline prices. So we may actually have a 0.4% increase in our in our earned income proxy, which is a proxy for wages and salaries and personal income. It's at an all-time record high. Um, let's see. Okay, let's move on to this one. So this is a bubble in bubbles. I think you all got it over the weekend. I think I put it out actually on Saturday. So here's the bubble back here in tech. We had this is information technology. The forward PE got all the way up to like 55 for the S&P 500. It was boosted by that up to about 25. The PE then proceeded to compress in the technology area, brought down the PE for the overall market. Then they were pretty much even Steven until here we got the tech PE going up into the 30s. Wasn't anything like this, but now it's come down not because the stocks have crashed, but because earnings because of FEMO. So this is FOMO, fear of missing out. This is FEMO. So these stocks don't look particularly expensive unless the market doesn't really believe the earnings forecasts, and that's exactly what we're seeing here. Investors are not willing to pay this kind of multiple for FEMO earnings because they're not convinced that they're sustainable. So, we don't have a real problem with a FOMO bubble here. But then again, we could have analysts kind of rethinking what their optimism about earnings. But it's not based on just kind of guesswork. It's based on the fact that earnings actually have been very strong. Obviously, there have been some quality issues in the earnings with capital gains accounting for other income in total earnings. But it's all known, and it doesn't look to me as though it's in a situation where we've got too much irrational exuberance in earnings. So here's FOMO again. This is market cap versus earnings share. So the market cap of tech got up to 32%. Now we're up. Well, we got up to almost 40%. But this time around, we also saw that the earnings share has increased dramatically. This is something we're watching for irrational exuberance in FEMO. You can see that the analyst expectations for long-term earnings growth, they are asked by IBES. IBES collects data on their opinions of what the next 3 to 5 year growth rate is going to be for the earnings of their companies. And when you put them all together, you get 25.5, which is beats that and certainly beats that. And now when you look at LTEG for the information technology, it's off the charts at 43.5 compared to 28 back here. So maybe that's where it is, but this doesn't really enter any PE times Z equation other than a sign of irrational exuberance on the E side. And on the E side, maybe the thing to watch is the profit margin. Maybe that's where the irrational exuberance is. And you can see in the semiconductors a good example of, I mean, semiconductors always had a relatively high profit margin because they constantly innovate, come up with new products with a high margin. The old stuff's margin kind of collapses. But you can see that the profit margin, forward profit margin really took off, and now it's at 50. And maybe this is what's due for a surprising drop here. But I think that would require that suddenly there's a lot of excess capacity that's come on stream all of a sudden, which is very unlikely given how difficult it is to build plants that make these things. But the interesting thing again is look at what investors are willing to pay in the semiconductor realm for that kind of profit margin, less and less. So they're not that comfortable with the profit margin. So that gives you a little bit of cushion on the irrational exuberance. Doesn't look like we got that much irrational exuberance on the PE side, and maybe it's on the E side. And I think if it bursts, if suddenly these stocks take a big whack, I think the 493, excluding maybe not just the Magnificent Seven, but also excluding some of the semiconductors, the market's broadening, in my opinion. That was my opinion before the war. With the war, it narrowed down again. Look at this here. See, I wasn't kidding around. I wasn't fooling you. This is, although I could have, I guess, doctored this chart, but I didn't. This is the data we get from IBES, which is now which was Thomson Reuters and now is LSEG. Look at this. They're looking at $402.96, and they just keep raising it. And if it just kind of goes flat here through the end of the year, multiply it by 20, and you get 8,000 on the S&P 500. It could very well continue to go up. It could crash if we have a recession, which is not in our forecast at this time. Forward earnings, all-time record high, even raising 2026, which becomes less relevant as the market gives more weight to 2027. What do we have here? Oh, this is just, so we're at the top of the heap, 8,250. That's 10% away from where we are now. It's not that crazy a number. And basically we have 6 months to get there. And we were up 9% during the first half of the year. So why not, given what the earnings story is doing? Here's more of that earnings story, year-over-year percent change, and the quarterly numbers, double-digit numbers over 20%, I should point out. Diffusion, the breadth of forward earnings, 3-month percent change, That's looking mighty good. This is market weight over equal weight, thinking that market weight started to underperform the equal weight at the beginning of the year. The war hit, that changed, and now we're resuming in that path. And we think the market is broadening to the 493. And it's broadening out to the SMID caps. Russell 2000 broke out back here, uh, retested it, and now it's kind of launched up into new highs. Dow theory is bullish. Dow transports and Dow industrials are both in record high territory. This is the 493 year to date using the XMAGS ETF, and this is the MAGS Magnificent Seven using the MAGS ETF, and it did recover kind of nicely here, but still year to date we're way ahead with the XMAGS compared to the MAGS. Meanwhile, sentiment is neither here nor there, which means that there's probably more upside. We don't have too many bulls in the market, which is a good thing. Um, and then just for fun, I threw in some winners that kind of are very pleasing to the eye and to the portfolio if you happen to own some of them. But information technology may be seeing some rotation, has been seeing rotation away from the Mag 7 and the software into semiconductors. Maybe there'll be some reversal of that for a while, but we remain market weight in tech for reasons we've discussed before. Cybersecurity, again, even in software, it's not all uh, black and blue. We're seeing some gray here, some red, I should say, some not red, but some real rebound here in this sector. Financials is one of our overweight sectors. That's breaking out to a new high for the banks. Banks are looking good. Investment bankers may be stalling out a bit. Healthcare, another favorite. Biotech looks really good, and pharmas are starting to look really quite good. Industrials are a favorite, should do quite well. So I hope you all had a great July 4th. I hope the weather didn't disturb it too much. Let me uh, jump here, and if you have a few minutes more for me, I'll take a couple of questions. Uh, I got some long ones here. Let me see if I can cut to some of the shorter ones. Kevin, the Trump account officially launched on July 4th. Can you comment on what the tailwinds are and its impact to equity markets? I think initially it's relatively small, but I think in long term, I think it's great. I did write a book somewhere here. Here it is. I'm just looking at it. I wrote a book in praise of profits, and I'm not going to. And then let me see when I wrote it. Um, 2021, and in that book, I suggested I didn't call them Trump accounts, but thought it would be really cool if the government seeded S&P 500 accounts for every baby that was born in America, and it's the same idea. Um, Chip, per a Dallas Fed working paper, unauthorized immigration drove a 30% surge in local home prices from 2021 to 2024. Now, the 5-year break-even rate has dived nearly 50 basis points. It's a harsh drop, but perhaps reflective of falling oil, a housing plateau, Chinese EVs. Uh, is a disinflationary regime in the offing? Well, it is for some of the reasons you mentioned, but I would throw in productivity as the most positive reason to believe that disinflation is possible. Goldman's James Schneider has NVIDIA at 14 times his forecast for its earnings in 2027. That was somebody just a comment, not a question. I'll take a couple more, and then if you have a minute for me, and I see some of you are hanging around. Um, Last year, you mentioned the stock market support a 22 times forward PE multiple because there was little risk of a recession. Today, we are a 20 multiple. How do you think about that fluctuation? Can you please discuss the drivers of the decrease and whether we could see another 10% decline over the next year. Yeah, I mean, obviously it's PE times E, and the PE can be a source of a lot of volatility. It is a source of a lot of volatility because earnings expectations typically grow because the economy typically grows. But every now and then you get a recession scare. If that's all it is, then the earnings expectations continue to rise. If the recession scare turns into an actual recession, earnings take a dive. So a lot of the short-term issues of the PE. Yeah, in sort of my write-ups on earnings and kind of projecting to the end of the decade, I've been using 18 to 22. And I'm just saying recently we're at 20. I have no problems with that. Times 400 is 8,000 by the end of the year. And I think we'll get to better than that because the earnings expectations could be better than 400, or the PE could be 21, 22. On the earnings side, I actually haven't been bullish enough, and I've been among the bulls all in all. One last question. Kyle, we can all agree that some portion of the SPX earnings momentum surge is a result of CapEx spending from other members in the index. Whether that recycled component is significant or problematic may be debatable. Do you have a way of stripping out or normalizing that impact, say with something like index level free cash flow? Do you worry about those types of distortions, double counting, or is it just wall of worry fodder? It's not wall of worry fodder. It's realistic issues. I can't say that we've sat down and really come up with a good way to say how much is solid, high quality earnings and how much is somewhat debatable. I think with regards to the mark-to-market capital gains that a few of the companies have in other companies, those are one-time situations. Analysts are going to obviously have that reflect the latest earning season, but they're not going to extrapolate those kind of gains. Maybe that creates some irrational exuberance where things get hyped up. But anyways, hope everything is working out well for you folks. We're basically the middle of the year. Time flies when you're having fun. It's been a real roller coaster so far. Uh, I'm not sure. I mean, there's so much talk about bubbles, and Kevin Warsh is the new Fed chair, and everybody's kind of speculating on what he's going to do. He's clearly pivoted to a hawkish stance, but you know what? Maybe the surprise will be that things kind of calm down here, and that even Kevin Warsh may not have to do much. We were right about him pivoting to a tightening stance. We weren't right about him. We were right about the FOMC pivoting towards a tightening stance. What surprised us is the extent to which Warsh went along with it. Now we think our 25 basis point rate hike in July is still on the table, but it's not our, highest conviction bet at this point. Our high conviction bet is we're in a bull market. Enjoy. Thank you.